Well, happy Thursday, everyone. Took me forever to get hooked up today for some reason, and I apologize for that. So, in addition to my normal speedy speaking, we're going to go probably faster. I've got a good presentation today, and hopefully you'll get some good information out of it. I sincerely apologize for the delayed start period here. And we'll get going right now, so I won't be burning any more of your valuable time. So today's topic: silver, gold, and real estate, self-directed retirement accounts, and recession investing. My name's David Moore, and I'm with Equity Advantage and IRA Advantage. Equity Advantage handles 1031 exchanges. IRA Advantage handles self-directed retirement accounts. So we are going to be talking about self-directed retirement accounts and some of the fallacies that exist in that space. Everything we're talking about today has been actually available to investors since the inception of retirement accounts. So this is not new information. It's just, I sort of believe it's well-guarded information. And my background was investment real estate. My brother and I, Tom, started a company called Equity Advantage to handle tax-deferred exchanges in 1991. During the ensuing years, we had lots of clients coming to us saying, hey, I've been told, or I understand I can use my IRA 401k to go buy real estate and buy things that Wall Street doesn't sell. How do I do it? And I'd go to seminars, presentations on it. I'd sit there all day long. I'd walk out understanding how to make the investment that company wanted me to make, I guess I should say, and wouldn't really have the information that I wanted. And so what we're going to talk about is how to do these things, the basic do's and don'ts. It's really not that complicated. And as I said, it's not something that's new. It's just something that people really don't know much about. And if you think about, for example, 1031's over 100 years old at this point. And there's very little case law in 1031. If we look at retirement accounts, they were started in the mid 70s, and we have even less information out there in the self-directed retirement world. Most financial advisors are going to be able to help you and understand what you can and can't buy when it comes to their offerings and the benefit of making those investments. But when it really comes down to what somebody is able to invest in off the street, for example, there's not a lot of information readily available out there for a variety of reasons. We are going to, since we're talking about silver and gold, we're going to talk about something called a gold IRA, for example, and then lots of misinformation there too. So we'll sort of dispel the fallacies involved with some of this stuff during the next hour. So self-directed, it's not a legally defined term. It's just a term that describes an account that allows you to go buy what you want to buy. And it's really pretty black and white what you can and can't buy. Where we start having issues is benefits or burdens, to a disqualified party. We'll go further with those conversations a little bit. But once again, it's not a legally defined term. It's just a term that describes an account that allows you to go buy anything the law allows. And that's sort of, I guess I should say, my definition of a truly self-directed account. You might talk to some of the big investment houses on Wall Street and say, well, hey, they've got self-directed IRA accounts. And if I am standing in front of the room today with 50 people in it, and I ask for a show of hands, the number of people that say they might have self-directed accounts might be 20% of it, or 20% of you. Well, I start asking who the custodian is for an IRA, and it's going to be very clear to me very quickly that you've got what that company defines as a self-directed account, but it's not truly a self-directed account. A truly self-directed account literally allows you to buy anything the law allows, and I just want to be clear about that. We all hear ads on this stuff, and we hear ads and people talking about gold IRAs or self-directed accounts, different things. And as I just said, they're not truly self-directed. There's actually no such thing as a gold IRA. It's just an IRA, a self-directed IRA account that's been put together by some sponsor that specializes in precious metals. But any self-directed IRA or solo 401k plan is going to allow you to make these investments. So it's not something where, gee, I need a gold IRA to buy gold or a silver IRA to buy silver. Any self-directed IRA is going to allow you to do this. Now, the way to make those investments might change with the different structure that's involved and where you keep that precious metal is going to change, obviously, too. But any self-directed account should be able to hold precious metals, and I just want to be clear on that. So why do people look at, and it's really interesting to me, why do people look at self-directed accounts in let's say, you know, especially times like we're in recessionary times or potentially recessionary times, depending on definition once again. You know, really it's diversification. Any financial advisor is going to talk about diversification. So, you know, some people might be tired of the stock market's roller coaster ups and downs. You know, one of the funny things about real estate, for example, is people say, well, it's not liquid, you know, so, and you know, therefore it's tough. You shouldn't hold it in a retirement account because what happens if you've got to take an RMD or something like that? You have no cash in there to take the RMD. Well, who says, once again, an RMD, by the way, is a required minimum distribution. Who's to say an RMD has to be in cash? And that's something that Wall Street lives by pretty much. But, you know, in my world, a lot of people take in-kind distributions. You know, well, David, what do you mean by an in-kind distribution? Well, an in-kind distribution means that you might have an asset you really like. You might have a multifamily building or mini storage, something that you love, and that thing's owned by your retirement account. Well, you don't own it, your retirement account does, so all the benefits and burdens of ownership lie with the retirement account. If there's some tax generated by that thing, it's not taxed for you, it's tax on the retirement account. So I just want to, you know, stress right up front, when we put these accounts together, a lot of times people think the investments they're making with them are theirs. And I really want you to think about it as Susie down the street. You're not going to, you know, provide Susie's insurance. You're not going to take her money. You're not going to be a guarantor on a loan for her. You know, if there's some downside, you're not going to take those things. It's hers, not yours. Think of the retirement account as Susie's, not yours. And by doing that, you're going to be much safer in these things. Because if you think about, let's say you for example, go out and buy an income property and the monthly cash flow, you think, well, gee, that cash flow is mine. It's not, it's the retirement accounts. And you're not going to have any, you know, personal tax consequence until you take funds or something out of that account as a distribution. That's where the transfer of benefit goes from the retirement account to you, is by taking a distribution. So when people come to these things, you know, if you say, gee, David, I want to go out and buy an apartment building, I need more cash flow. Well, yeah, that cash flow can be yours, but you're only going to get that cash flow as it's taken as a distribution from the retirement account, and there's a process to be followed there. So the retirement account's going to grow, what's in it's going to grow, and one of the huge benefits, obviously, of owning real estate in a retirement account is you're not banking on that thing going up in value. The cash flow in itself is going to increase the value of your retirement account and benefit you. So, you know, overall, it's going to increase over time too. But you know, that's why we always have those. You know, the past returns are not indicative of future returns, right? I mean, that type of statement's made. But people are tired of the stock market's roller coaster. Greater financial control. What do I mean by that? Well, the example I just gave you is one of those examples. You're not betting that it's going up in value. It's going to do other things for you. Invest in what you know. If you've got specific knowledge of something on Wall Street, unless you're in the House or the Senate, you can't take advantage of that. You know, ask Martha Stewart about that. And you know, the deal is that insider trading, that's a no-no on Wall Street. If you're a mortgage broker and you want to make loans with your retirement account, you can do that. I mean, that's something that hopefully you're going to minimize the risk in a given investment by investing in something you know. And with self-directed accounts, you can actually do that. Increased investment flexibility. Why not have an account that can buy anything the law allows instead of being pigeonholed into just something that allows you to buy Wall Street's offerings? There's really no reason that you wouldn't want an account that allows you to buy anything. So, you know, depending on what type of account we're working with and what you're wanting to invest in, we're going to take different positions on that. And by the way, IRA Advantage does not provide investments or investment advice. We merely provide the investment vehicle that allows you to go out and buy what you want to make the investment in. Real investments, not alternative investments. Now, this is something that sort of bothers me. I'm a real estate person. I've been dealing with hard assets, you know, pretty much my whole life, adult life. And if you look at in the investment world, anything Wall Street doesn't sell is considered an alternative investment, it seems like. So everything that we're talking about today is an alternative investment. Alternative investments to me make them sound more flimsy. And I would argue that the alternative investments are really, truly the oldest investments known to mankind. I mean, what's older than precious metals or maybe jewels or real estate, for example? Now, I want to stress collectibles do not qualify for IRA 401k investment. So we're not talking about collectible items. We're purely talking about investment grade options and when you're buying precious metals, for example, it's critical you're working with a broker, investment, a precious metals dealer that specializes in this arena and will be providing investments that are IRA and 401k compliant, because lots of them are not. Community-based investing, you want to make a difference locally, you can do that. You want to take advantages of something locally, you can do that. So community-based investing, put your money where you are, where you want to be, not somewhere across the world, for example. Take advantage of today's opportunities. A checkbook IRA, solo 401k literally make investments available by a pen stroke. So they're really attractive vehicles for people. Tangible assets, great hedges against inflation. We've talked about that. And finally, security. What do I mean by security? Well, the security issue is one of know where your money is. If you've got your funds with a traditional Wall Street investment firm, that money's wherever they are. If you want to put your checkbook IRA in a bank that's a regional bank, you can do that, or a solo 401k, the same situation. You literally have the accounts for these investment vehicles at the establishment you want to have them in, and that can be right around the corner, or it could be around, across the globe. Doesn't really matter, but it's where you want to put it. So that security is really something you have lots of control over. Common objections. These are the things that I hear every day when we're talking about self-directed accounts. And we're going to dispel these, probably the top 4 right now. One of the first questions people ask, well, why would somebody want to, buy real estate with a let's say an IRA or 401k when you're going to lose long-term capital gains tax treatment with those things? Well, that's a true statement. And what do I mean by that? First off, I guess consider an investment that's held for under a year. You're going to be taxed at normal income tax rates. If it's if it's held for investment for an excess of a year, you're going to get long-term capital gains tax treatment on that. Now, with retirement accounts, any distribution is taxed at normal income tax. So it really doesn't matter how long you own the thing. It's just taxed at normal income tax rates. So when somebody makes a comment, well, gee, if you go out and pull money out of your pocket, go buy that property, you hold it for a number of years and it's held for investment, worst case scenario, at the end of the day, you sell it, you pay long-term capital gains tax. Now, the best case scenario is you just utilize 1031 and swap till you drop, for example, and at the end of the day, your heirs are going to get a stepped up basis current market value, and they wouldn't have any tax consequence on that thing. So it makes a huge difference with what you're doing, how you're using this stuff. But if we're looking at retirement accounts, all retirement accounts are taxed in the same manner. So it really doesn't matter what you're buying with this stuff, you're going to have the same tax consequence. So when we talk about loss of long-term capital gains tax rates when buying real estate, well, really doesn't matter. You should be looking at the investments in your retirement account as what's going to give you the best, safest return, and make those investments, because no matter what you're investing in, the tax consequence is going to be the same thing. If you're saying that if only given a choice of buying with money out of your pocket or buying with qualified money IRA 401k funds, then I'm going to tell you obviously that there's many benefits to doing it with money out of your pocket that are not offered by investing in that same piece of real estate with your IRA 401k, because you're not going to get interest benefits there. You're not going to get the depreciation that you get, and you're going to have special requirements with respect to lending in those situations. Another comment's made all the time, cannot be leveraged. An IRA cannot be leveraged. Well, that's not true. You can do that. So if we're buying a piece of property with an IRA 401k plan, you can get a loan. It's just got to be non-recourse debt. What I mean by that is you're not the guarantor. The only recourse the lender has in a default is to take that asset. They can't go after anything else the retirement account has or that you have. And furthermore, I mean, it's possible for you to be a joint owner of a property along with your retirement account, but you cannot grant recourse to your portion and have it non-recourse to retirement. So don't come up with that idea as a great workaround on it. If you're a part owner of the asset along with a retirement account, if it's got a loan on it, it's got to be non-recourse debt. Next statement, what about RMDs? I made a comment earlier about real estate's considered not liquid. Well, what happens if, actually I had a call yesterday on this topic. So you're in a situation where you've spent all your money on the piece of property, and now you're in a situation where you've got to take an RMD, required minimum distribution. At that point, you're thinking, well, gee, I'm trapped. I don't have the cash to pay to take the distribution. Well, a simple workaround is just to take an in-kind distribution. What I mean by that is you're going to take a piece of the asset. And this is not only a solution there, but it's potentially an opportunity. For example, if you own a piece of property in a limited liability company, shouldn't say you, Susie, via your retirement account, your IRA 401k owns a piece of property via a limited liability company. You want to start taking pieces of that property. You would just do a simple assignment of membership interest, and obviously the trust company is going to be involved with that assignment, or you're going to work with your tax or legal people on these things with 401k plans too. But you just do an assignment of membership interest. The title doesn't even change, and as long as each of those distributions of minority interest are a minority interest distribution, it's even possible to discount the value of that distribution by up to 40%. Now, this discounting is often used in gifting for estate planning purposes. It's not really contemplated that much with distributions, but that same argument can be applied. And that's a conversation you'd have with your tax counsel. But don't look at lack of cash in an account as being problematic to you for an RMD, because you've always got that in-kind distribution option for required minimum distributions. And finally, you lose interest deductions depreciation. I talked about that earlier when we were on bullet point 1. I just got too excited, got ahead of myself. So once again, if the retirement account owns the asset, you do not, so that you're not going to get interest deductions depreciation. Typically, the retirement account's not going to be taking that. There are situations where you might have some deductions taken if you've got a leveraged investment with an IRA. So what I'm going to say right now is that be aware that if you buy a property using an IRA and you get a loan on that property, first off, once again, it's got to be non-recourse. You're typically looking at maybe 60-65% at most loan to value, but any income or gain attributable to other people's money is going to trigger tax exposure. So if we're looking at an IRA owned asset with leverage, and it's, let's say 50% LTV, half the income is going to be taxed, and the tax liability, once again, is the retirement account's not yours, and then half the gain would be upon disposition. So you'd want to pay that thing off well in advance of selling a property to avoid the tax on depreciation recapture, if that's going to be applicable there, or the tax on the income or gain attributable to the leverage too. So just be aware that leverage investments are going to be looked at differently, and like I said, typically you're not going to be seeing interest deductions or depreciation on an IRA 401k owned asset, although there might be a scenario where that could take place. Everything you need to know. Remember, about 20 minutes ago, I said it's not complicated. When we're looking at a 1031, for example, I sort of break it down to my 4 cornerstones. 1, it's got to be an exchange. 2, it's going to receive or like kind. 3, we've got to go across or up in value and equity. And finally, we've got to have continuity of vesting. If I'm looking at a self-directed retirement account, I look at 2 issues. What does a person want to buy? And two, who are they transacting between or for the benefit of? So it's pretty easy to look at those two things. What do you want to buy and who are you transacting between or for the benefit of? Now, as far as what I can buy, I can literally buy anything other than collectibles, life insurance contracts, or stock in a sub S corp. As far as the benefit between disqualified parties, it'd be lineal ascendants, descendants, their spouses, or any legal entity owned and controlling interest by one of those. Now we've got a page that further explains these two topics, but that's really what I'm concerned about. So as far as investments, as I said, with an IRA, you can buy literally anything other than collectibles, stock in a sub S corp, or life insurance contracts. You're probably not interested in doing any of those things. Maybe the collectibles, especially when it's metals, you might look to buy collectibles. You can't. Obviously, collectible cars, those things, those are all no-nos. It's interesting because with a 401k plan, you can buy literally anything other than collectibles. So the spectrum of possible investments is even broader with a 401k plan. And by the way, if you've got a quote unquote self-directed IRA that doesn't allow you to do this, it's not by law, it's by that administrator, that custodian, that trust company. That's their restrictions, not by law. Restrictions. And if you got a 401k plan that doesn't allow you to go out and buy what you want to buy today, it's once again by plan document or administrator. It's not by law. So you can, if I get a look at a 401k plan, somebody asks whether they can buy something, first thing I'm going to do is say, hey, read your plan, see what it really allows you to do, because a lot of times the administrators haven't even truly understood what's possible. I had a discussion a few years ago. My client was an ex-IRS auditor, a CPA, and a real estate broker, and he came to us, wanted to make an investment in a Tennessee and Common multifamily project. And I asked him to see his plan, and his plan allowed such an investment. And this was a time-sensitive deal, so it made sense, and economically it made sense if he could just use his existing plan to get what he wanted done. So I asked him to go speak with the administrator about it. The administrator was arguing about that document, and I said, well, let's talk to him. So let's get on a conference call and talk to him. I cited the paragraph and the sentence talking about the possible investment, explained to him this was time sensitive and they'd be helping their client with an investment their plan clearly allowed, and it was the best thing to do for everyone. And it was really interesting. I had to argue the point, and finally they went to the legal counsel and came back with the decision they would make the investment, but it would take them like 60 days to approve the investment. So we ended up, I said, well, okay, at this point, we're just going to replace your plan then. So typically we'll look at a plan, see if it allows it. If it allows it, great. If it doesn't, can the plan be amended to allow such an investment? If it can't be amended to allow the investment, then we replace the plan. And that's what we ended up doing in this situation, got him where he needed to be. But all these things take some time. And it's really important that you have the investment vehicle structured prior to going shopping. And we'll talk about that a little bit more in a few minutes, but it's really critical you're ready to go do this thing before you can start looking at it, at investment opportunities, and you get excited about going to buy something. Any investment must simply be made for investment purposes, and purposes. Sorry about that. Disqualified parties. So one, we talked about the investment, and once again, IRAs can buy anything other than collectibles, life insurance contracts, or stock in a sub S corp. 401ks can buy literally anything other than collectibles. So rarely is the investment a problem. What triggers problems for people is transactions between or for the benefit of a disqualified party. So if we look at who's a disqualified party, lineal ascendants, descendants, their spouses, or any legal entity owned by a controlling interest by such, the manager of your IRA, investment advisor to your IRA, person with discretionary authority over an IRA, other legal entities you own a controlling interest in. So any of those things are problematic. And I want to stress that you can transact along with a disqualified party, meaning you could be a joint owner you personally could actually be a joint owner of a property along with your plan. You just can't buy from, sell to, loan to, borrow from. You can't be a guarantor, that type of stuff. So that's where we're talking benefits. I would stress also that if we do a variety of different accounts in here. So if somebody wants just the most basic self-directed account, really that just means we're establishing a custodial account where the trust company allows you to make the investment you want to make. Now, the issue is that if you personally tie up the property, so back to my comment about being ready. So let's say you're all excited, you find a property that you just got to buy, and you want to buy it with your retirement account, and so you personally tie it up because the broker says, well, gee, the purchase sale agreement's got a right of assignment, so we'll just sign over the plan in the future. Our position is that that would constitute, or at least potentially constitute, a prohibited transaction. I'm not going to say it will, but I'm just going to say our position is we don't want you to do that. We'd like you to be ready so that when you make the offer, think about in a basic self-directed IRA situation context that the custodian would literally be the owner of your asset. It would read, ABC Trust Company, CFBO custodian for benefit of John Smith, IRA number, whatever it might be. Now that's what the purchase sale agreement, and do you have the power of the pen for the trust company? You don't. So I mean, that's where it's tough if you got a basic account. Now, if you've got what's called a checkbook IRA, you're typically going to be the manager of a limited liability company that has the trust company as its member. So you can go out and write that purchase sale agreement between the seller and your checkbook IRA LLC, and you as manager have the power of the pen to go do it. Now, I'm still going to say don't tie up the property personally and then assign it over to the IRA LLC or anything else, because there's a benefit to a disqualified party. From our perspective. Now, trust companies might do that. They might allow it to be done. Every trust company is going to have a different policy on that. We just feel that it's your retirement account. You got to be conservative on it, and it's best to be ready, do it right from the beginning. So, once again, I'll stress buying from, selling to, loaning to, borrowing from, no-nos. But as far as going along and purchasing along with a disqualified party, that's not a problem at all. Now, something I want to state is that we did not mention siblings, right? There's no mention of brothers, sisters, aunts, uncles, cousins. None of those are disqualified parties. So, maybe if you've got a property, you got to make an offer on right away. Have your brother, sister write the offer, and then you have the offer assigned from them over to your checkbook IRA LLC when it's ready, your 401k plan, whatever it might be. So that's a workaround. The only dumb question is the one that's not asked. So please reach out anytime you got questions on this stuff. Prohibited transactions. The problem with a prohibited transaction is it really treats all funds in the account as distributed as of the first day in the year in which the indiscretion occurred. That's with an IRA. A 401k plan is a totally different scenario. The prohibited transaction is only going to impact the funds involved with indiscretion. So it's really important that you stay away from prohibited transactions either way. But with IRAs, they're potentially catastrophic. So examples of the most common prohibited transactions. The one issue we've been talking about, assignment of purchase sale agreement from the taxpayer to their IRA LLC. Having recourse debt is another big no-no. Contributions, distributions directly between the IRA LLC and the account owner. So with the checkbook IRA, once again, you're going to have a bank account in the LLC's name and EIN. You're the manager, the member's the trust company. If you want to make a contribution to your retirement account, it has to go through the trust company. They make an additional investment in the LLC funding that bank account. You want to take a distribution, the funds have to go from the LLC back through the trust company to you. So there can never be a transaction directly between you and your checkbook IRA LLC. Anything there would constitute a prohibited transaction. Working on the IRA owned asset. Now, I have lots of people who want to go flip properties with their IRA because somebody said, well, gee, number one, why not do that? Because an IRA owned asset, you've got automatic tax deferral, and anytime you're flipping properties, you're paying normal income tax on stuff. And that obviously is very difficult. Well, understand that, yes, you can go out and buy that fixer property with a retirement account, but you cannot work on that property. You're a disqualified party, there's a benefit to your action. Sweat equity is not okay. So you can do the administrative functions of managing the asset, but you cannot go out and get dirty on it. What do I mean getting dirty on it? Can't go out paint it, can't go out swing the hammer on it, can't go out work on that property. So just stay away from all that. Pay vendors to take care of the problems that are there or the things you need done, and you can administratively manage the asset, but you cannot work on it anyway. All right. Using the IRA owned asset in any way. So a lot of times people will say, well, gee, I want to go out and buy a property in Mexico, or I want to buy a property in Hawaii, or whatever it might be. And number one, can I, write off my trip over there to take care of it? No, because it's not yours. It's as I said, it's the IRA's. It's Susie down the street, right? So it's not yours to write off. You can't write off those trips, take care of that stuff. But you cannot use that property, nor could any other disqualified party use that property in any way. Now, earlier I said something about taking in-kind distributions, or maybe you want to go out and buy a property that is to become your retirement house. That's fine, you can do that. You just can't use it, nor could any other disqualified party use the property until it's been taken out as a distribution, fully taken as a distribution. And at that point, it's yours, and do what you want with it. But while it's owned by the retirement account, you cannot use it, nor could any other disqualified party use it in any way. So let's say you got a kid going to college, you want to buy a property with your IRA or 401k for little Johnny to live in while he's going to college. Well, you can't do that. Johnny's disqualified party as your kid. So use of taxpayers' personal insurance policy. This is another situation comes up a lot. You just add the IRA-owned asset as an additional, property on your homeowner's policy. It's not yours. It's the retirement account. So that property should have its own entirely separate insurance policy. And once again, the cost of that policy is paid for by that retirement account. If there was a loss, then it's the retirement account's loss. Everything's going to be dealt with on that side. So I just, as I state on this slide in italics, the best way to look at the retirement account is consider it someone else's. By doing so, you're going to be safe in what your actions are. If you look at it as you or yours, then potentially you're going to have a problem there. Few things that get asked all the time, and the first one we just talked about, can I work on a property owned by a retirement account? No, you can manage it, but you cannot work on it. Sweat equity is not allowed. Can I be a guarantor on a loan for my retirement account? No, you cannot. That would constitute a prohibited transaction. Any loan on a retirement account's got to be non-recourse debt. Can my business occupy a building owned by my retirement account? Now, this one comes up a lot of times. For some reason from law firms, but it seems like more often than anyone else. So probably law firms and doctors, but no, you can't take your retirement account, buy a building and have your business occupy it. So it's just the way it is. Can I write off expense for travel? We talked about that last slide. No, it's not yours. It's the retirement accounts, so it's not your expense. You can't write off those trips to take care of that stuff. So we've talked about real estate, actually a little bit about what qualifies, doesn't qualify. Really, it's just got to be property that's acquired with the intent to hold for investment. So it could be office buildings, strip malls, places beach to retire into, land, apartment buildings, any real property acquired with the intent to hold for investment, period, is going to be okay. We look at precious metals, it really, typically it's going to be in the form of coins or bullion. And it's got to be a certain specific, level of purity. It can't be just collectible coins. So when you're working in this space, make sure that you're working with a broker that specializes in this stuff, because we don't want you buying something that is not going to qualify for your retirement account. So it's really, once again, critical working with people that know what they're doing. And back even to your tax and legal people, a lot of this stuff, I always say, when we're going through a transaction with somebody, what fits, doesn't fit, whether it's 1031s or IRAs, we're going to arm our clients with information on areas that we might have a concern about. And we do that because we understand that these are pretty niche products and really a sort of niche acknowledgement level on them. So, we feel that if we can get you armed with the appropriate information, then you're going to be paying your professionals for an opinion on these things, not paying them to learn on your behalf. So I really think, when you have a self-directed account. If you have income properties, you want to make sure you're working with tax and legal people that have experience in that space, specialize and not, don't just pay for a tax return, pay for a CPA that's really going to know the stuff and be able to give you some guidance with respect to these things. So, another comment about precious metals is you need to understand, typically they need to be, stored someplace, and this is not something you'd take lightly. Now, there was a case a few years back with the checkbook IRA where it was actually treated as a prohibited transaction because the taxpayer had a vault with not just their precious metals in it, but personal assets as well. And so they commingled the assets into that common vault. I don't know if that was the true reason that the thing actually blew up the IRA, but just be aware that it's really critical that you keep these things right. If you buy one of the quote unquote gold IRAs, for example, you're probably buying from a trust company that specializes in storage of these assets. Every trust company or custodian is going to have some type of depository where these things are going to be held typically. And just be aware that it's really important that you talk to the people involved, understand what you can and can't do with respect to holding these assets, where they need to be stored. And it's going to vary depending on the type of investment vehicle you have. So why gold today? We talked about, the real estate, but, tangible assets, inflationary hedges, once again, diversification, relative investment stability, typically appreciates over time. Increased demand and low supply equal increased value. Gold serves as a monetary instrument. Now, I guess my one comment on precious metals, and like I said, I'm a real estate guy, so I'm used to having the other benefits that investment vehicle offers. Now, with precious metals, you're betting that they're going to go up in value once again. But I just want to caution you, make sure when you're working with different brokers with this stuff, understand you're probably going to be paying whatever the quoted price is for that investment on that day, plus maybe some type of load there. But understand, try to really investigate what kind of discount you're looking at upon a sale. So understand that, just because it's gold, you got to be able to do something at the end of the day, or silver or palladium or whatever it might be. Understand what the cost of a disposition is going to be in that space. Don't buy it. So for example, when I got taught investment real estate, the gentleman that mentored me, I was blessed to have a great investment mentor, and his position was, before you buy a property, know three things: what you're going to make, how you're going to make it, when you're going to make it. And I would say with the gold, understand you really got to look at it and say, understand, okay, what's my cost of acquisition? What am I really paying for it? Where's it going to be held? What's the carrying cost going to be there? And then upon a disposition, what am I truly looking at? Am I looking at face value of it, or what kind of discount am I looking? And really have answers to those questions before you make the investment, so you're not surprised by something later. And we've all seen the ads or heard the ads on the radio talking about precious metals and the ultimate tangible asset, blah blah blah. So just understand, there's lots of people pitching these investments, and just really understand, one, who you're working with, two, the cost of acquisition, three, the cost of disposition, and those carrying costs associated with it. And most of all, make sure you're working with a company that's going to be selling you investments that are that do truly qualify for IRA and 401k investments there. So what real estate qualifies? Rental house, apartment buildings, office buildings, retail centers, land, any property to be held for investment, future retirement home, can't buy a primary residence, second home for a disqualified party, or office building to be used by a disqualified party, as we said earlier about the doctors or lawyers. So how do we create these things? Simple, really. I mean, and it's not all or nothing, by the way. If you're talking about doing a self-directed account to go buy a specific thing, I'm going to encourage, once again, most of our people, they're just diversifying their investment portfolio. So I'm going to say, keep your Wall Street stuff where it is. If we're talking about IRAs, and only move what you want to use in the self-directed world in this new account. Now, any IRA can be self-directed. When we're talking about 401k plans, we've got to be careful. If it's a current employer plan, then if it's a current employer plan and you're not 59 and a half, then you're stuck. All right, that money's in that account. The only way you're going to get access to it is to walk away from the job or turn 59 and a half. At 59 and a half, you can take an in-service distribution. Any IRA, like I said, can be self-directed, but when we're talking about company plans, it's really important. If it's a previous employer plan, we can self-direct that. If it's a current employer plan, then we're going to be stuck until you're 59 and a half or you change jobs on those things. But I'm once again going to stress it's not all or nothing. And when we're talking about the IRAs, I think it's really important that we're looking at it and keeping, as I said, anytime we're looking at an IRA, a prohibited transaction is catastrophic, meaning that all funds in the account are treated as distributed as of the first day in the year in which the indiscretion occurred. So we're talking IRAs, keep your Wall Street stuff where it is, only move what you want to use in the self-directed capacity in the new account, and we'll structure it that way. Now, a basic self-directed IRA just means really we're going from trust company A to trust company B, and that's it. To make an investment, you'd submit the investment to the trust company. Upon their approval, they're going to make the investment. And as I mentioned earlier, if you look at who the legal owner is of that asset, if it's a piece of property, for example, it's going to read the trust company's name, CFBO, custodian for benefit of your IRA number, whatever it might be. If it's a checkbook IRA, it's going to be the IRA LLC's name. If it's a 401k plan, it could be the 401k plan directly, or it could be the 401k plan via any form of limited liability company, whether it's single and multi-member, doesn't really matter. But we can do these things any way we need to do it. But with a basic self-directed account, I would just be cautious in how you're writing purchase sale agreements, who you're writing that purchase sale agreement between, the seller and who. It can't be the seller and you and assign it over. So maybe get a non-disqualified party, like I said earlier, maybe it's a sibling to write the offer, and then at a later date when your account's set up, then you'd assign that offer from them to the retirement account and you're ready to go. So that's the issue with a basic account. If we're buying gold or some passive non-time sensitive investment, maybe you're buying into a fractional ownership of a property with some company that structures these things, and you're really simply buying in a membership interest in an LLC. Well, that can be accomplished with a basic account. You don't need to go through additional cost or time of creating a checkbook IRA. But if you truly want the immediacy of investment that a checkbook IRA gives you, then you're going to want that. Now, a checkbook IRA, they sort of came to be the Swanson case in 96, but really what we're talking about with a checkbook IRA or IRA LLC is simply inserting an IRA-specific limited liability company between the trust company and the ultimate investment. The member of that trust company would be the member of the LLC, I'm sorry, would be the trust company for benefit of your IRA, and you are the manager. It's a manager-managed limited liability company. So when you tell us go, we're going to create the basic custodial account as we normally would, but instead of having the trust company make that ultimate investment, the trust company is making the investment in the LLC, funding the bank account for the LLC, that you are the signer on as manager of the LLC to make the investment. You just negotiate between the vendor or the seller and the IRA LLC. They work great. They allow you to manage the asset, allow immediacy of investment. If you want to go buy an auction property, it's really the only way you're going to do it. Now, I want to mention that it is possible to combine multiple members, into that IRA LLC. That IRA LLC could be two spouses in their respective IRAs. It could be maybe you have a traditional and a Roth IRA. So if you want to combine traditional funds and Roth money, by the way, traditional IRA is pre-tax money growing tax deferred. A regular 401k plan would be the same way. A Roth IRA is taxed money that grows tax-free. So you could have your traditional and your Roth, you could have your traditional and your Roth, you could have your spouses in there too. All those things are possible in that IRA LLC. You could even be a member as well. So remember, I talked earlier about taking in-kind distributions by doing an assignment of membership interest. Well, maybe your checkbook IRA has a single asset and you want to slowly take that asset out. once again, it started off as solely the trust company being as a member, but you're signing a membership interest from the trust company to you. Just as you can do that, you can create that investment vehicle from inception with those too. Now, if we've got a multi-member limited liability company with disqualified parties as members, it's critical that we, let's say, overfund the initial investment in that account. We feel it's much more conservative. We want to have all the money in from those disqualified parties in at inception of the LLC, because we sort of have the position that it's more risky if you have funds coming in at a later date, because the initial funding, the entity's empty and you're not transacting between disqualified parties. After that account's been funded and now is working, it's got as its members two disqualified parties, and it could potentially appear that you're committing a prohibited transaction if you were to make an additional investment in there. Now, it's really a trust company policy on how they treat those things, but our position is just to be conservative, and we want to be conservative as possible in these things to overfund the initial investments so you're not faced in that situation. We do, let's say an emergency situation, if you had to get money in there, we've got some workarounds that can, be investigated if you have a situation that needs a major capital injection to get something done. Solo 401k. So there might be, typically we have a number of real estate brokers on a call. So if you're a real estate broker and you have, let's say you're continuing to work, you are in a situation where you have no employees, or maybe you and your spouse work together, a solo 401k can be a great solution there. And there's some benefits to that. Really, you've got a bank account, the plan's name and EIN, and you don't have a custodian. So we can't fund that 401k plan with Roth money, nor can we fund it with a beneficiary IRA. Beneficiary IRA is one that's been inherited, so neither one of those qualifies. We can't move funds into that 401k plan from those sources, but the 401k plan, you can do in-plan rollover to Roth contributions, or to Roth funds there to make things happen. Both a SEP IRA and a solo 401k, they've got very high contribution limits. The highest short of a defined benefit plan up in the high mid 50,000 range, so they're pretty attractive that way. One of the issues with a checkbook IRA, or any IRA, for example, as I said earlier, you've got tax on leverage. So if it's a property that's 50% loan to value, you're going to have tax on half the income and half the gain. The 401k plan, you won't have the tax on that leverage. And if you ask me, gee, David, why is that the case? And well, some senator had the 401k plan. I don't know. You can't really rationalize why that is the way it is. It just is. So you don't have a custodian that's required. You can buy, anything other than, like I said, literally anything other than collectibles. So you can buy life insurance contracts or stock in a sub S corp. I honestly rarely have people that want to do any of that anyway. But the other benefit is that you can borrow, from that plan. Half what's in it to a max of $50,000. So that's attractive to people. Is there a downside? Really not so much. I mean, there's no reporting on that thing if you've got under $250,000 in it, and the 5,500 EZs, the form is typically used to document what's happened in a given year for that 401k plan. Other than that, I really don't see a downside of the 401k plan. But if you have employees, once again, you're not going to be able to use that. So very little in the way of administration costs. You've got either amendments or restatements annually, but that probably is going to be able to be taken care of for under $300 a year. So there's really not much to keep going. And one of the big things, like I said, is if in a not a default, but if you committed a prohibited transaction with a 401k, the consequence of that prohibited transaction is simply the funds involved with the indiscretion instead of full distribution of those funds. So joint ownership of real estate, and you've got two ways to do this, and joint ownership can be via tenancy in common, which is really my preferred manner, because you've got some benefits there. One, if you're in a 1031, you want to combine your 1031 funds with IRA 401k investment. It requires tenancy in common. And the reason it requires it is 1031 specifically prohibits partnership interest. So that 1031 is the reason that the TIC is structured, not the retirement account. But the tenancy in common structure, you have to have a tenancy in common agreement, a TIC agreement that spells out and has IRA 401k provisions in it. And if you've got that, it's a great thing. You just have a joint checking account with funds from both, personal and in plan in there. Everything's, paid pro rata in that. So any additional funds in or out, every expense has to be, paid pro rata the ownership of you personally versus the IRA 401k interest. So just be aware of that. The other side, TIC, in addition to allowing you to buy via a combination 1031 and the retirement account, upon disposition, you personally can just do a 1031 and the retirement funds go back into the retirement account. So it works great that way. Downside, lending might require a limited liability company. We're in a strange world where certain assets they won't allow an LLC owned, and other assets they require an LLC to own. And it's just sort of the world we're in. Don't ask for any logic here because there isn't much. And a lot of times it's interesting in the 1031 world. Vesting is one of my biggest headaches, and LLCs end up a headache because of that vesting issue. And it's sort of funny when I talk to a lender, we'll say, gee, the lender doesn't want the property 4 units or less held by an LLC. Well, why not? I mean, it doesn't isolate the taxpayer from the obligation paying the loan. It just isolates the taxpayer from the liability of the asset. I just think there's lots of misunderstanding out there with respect to what an LLC actually does for somebody or something. But anyway, joint ownership via TIC allows exchanging in, allows exchanging out, and allows the pro rata payment of things as they come up. And once again, it is required that you pay pro rata. If we look at the limited liability company, now you've got, the lender might require that. That's fine. You need to, as I described in a couple slides ago, over funding that initial, when we talked about structuring a multi-member checkbook IRA, talk about overfunding the thing because, put enough in that entity to make the purchase and cover any carrying costs so you got some cash flow building up in there. But, you've got some legal protection the LLC offers, obviously, and that's a nice benefit. You're going to have a tax return, for that limited liability company because it's a legal partnership, and then you'd have just a joint checking account. So you've got some, tax work that's there. You've got some liability protection that the LLC offers, and once again, the lender might require it or they might prohibit it. But that's one of those things that comes up. But a lot of times, as I said, on acquisition, I encourage people to use a TIC structure. On disposition or distribution, that LLC offers a lot of flexibility. So you're buying something and you ultimately want to own it personally, so you can take in-kind distributions. You probably want to buy the property. If you're combining personal and planned money in the initial acquisition, why not just use the LLC and then do the assignments of membership interest over the years, and that way you're not having new deeds drawn, you're not having a title policy that's no longer enforced or anything else. You're just going to slowly become the member over time, and I really like that approach. It's very attractive. So whether you want to use TIC or the limited liability company, it's really a case-by-case situation, and you really have to sort of discuss and look at what's going on. And as I said earlier, the only dumb question is the one that's not asked. So if you're contemplating a transaction in this space, don't just call us to put a deal together. Call us, ask a bunch of questions. Ask, tell us what you want to do, and ask us what sort of advice we're going to have for you with respect to structure. We're happy to talk to you. Business startups. This is something in recessionary times that comes up. People, lose a job, tired of a job, want to create a, new business. This is their opportunity. They maybe lost it, and hey, this is the moment to the retirement account, sort of the pathway to the future. So it is possible to literally create new business and that you're employed by using a retirement account. And really what we're doing is we're we're rolling your current retirement account into a new 401k plan. We're creating a C corporation. The plan buys the corp buys the business. We do require our clients to have 5% personal cash into the transaction too, so there'd be they would personally be shareholders of the corporation as well as the retirement account. And they work great, and we've done these for everything from gold, silver, palladium mines to car dealerships to hotels, and it's been fun to do them over the years. I often provide, I don't have in this presentation a slide talking about a situation where a couple came into us and they wanted to buy a mobile home park and using his and her retirement accounts. And what we did in that situation is they first told us they wanted to buy a park, and then they told us they wanted to be the on-site managers and live there. So we shifted from a checkbook IRA, which once again is a combination of an IRA and a limited liability company, to a rollover business startup, which is a combination of a 401k plan and a C corp. And in their particular scenario, they got an investment, a place to live, and a job all with that one transaction. So that sort of gives you an extreme example of what is possible using retirement accounts in different forms of corporation or plan versus IRA. So this is an example of just people's opportunity, and the lending world is getting just more and more complicated all the time. And if we're looking at people in the construction world, for example, we've got builders that put investment funds together to finance projects, and they work very well for people. In this guy's situation, this is the last recession, and he dirt was dirt cheap in those days. So what he wanted to do is go out and do a checkbook IRA in his situation. It was a chosen investment vehicle. We did checkbook IRA for him to go out and land bank property, and so we did that. But going forward, once again, think about, okay, you're creating this thing, you're doing this, but what's the end game? What do you want to do with this land? And in his situation, he knew he wanted to buy the dirt, and the carrying costs using traditional loans would be something that he didn't want to deal with. Why not have his retirement account gain that upside over time? And this allowed him to do it. Now the problem that came up was, well, he wanted to build on them in the future. Well, he can't build on something the retirement account owns, and he can't have his construction company buy from that entity to build on those properties either. So we created a second limited liability company, put some of his vendors in there as well, and reduced his ownership of that second limited liability company down to 1/6 owner. Now, as his interest was only 1/6 of the membership in the LLC, that entity was not a disqualified party to his checkbook IRA. So it worked very well for him, and that's what he did. So as he wanted to build stuff, the development entity would buy from the other entity, build it out, and turn it, and he just continued to use the initial entity as the land bank entity, and then the second tier LLC was one that was doing the business and contained the other vendors that needed to get it done. So that's an example of a situation where at face you say, well, can I do this? Can I not do this? Well, if you do it this way, you can't do it. If you do it this way, you can. So really ask the questions, look at what's going on, and work with people that understand all aspects of this stuff. Good tax and legal people, good finance people, and when we talk about the retirement accounts, understand the people that are involved, what their background is, and how they can help you get where you want to go. Another example, this is just a situation where somebody was wanting to go out and initially wanted to buy a mobile home park, but this is I just talked about in the last slide. Land banking also talked about people putting investment funds together to fund different projects. Now, a lot of our clients, most of them come here to buy property. A lot of them these days are buying notes, making loans though too. So this is an example of somebody that had a bunch of properties, tired of the terrible T's, toilets, trash, tenants, turnover, and now what he was looking at is, well, hey, can I do, his initial question was, can I buy the mobile home park? Which the answer would have been yes, and was yes. And then he came to us the next day, said, well, hey, can I buy paper? And that's ultimately what he wanted to do. In his situation, we did a single member checkbook IRA for him. And a lot of our clients will sort of dip their toe in the water. And I think that's a good, safe thing to do. So he put enough money in the account. His first investment was just a $70,000 property. David go, well, where's a $70,000 property? Well, this was actually during the last crash in Palm Desert area. Pre-crash, the property had been $250,000. And so now all of a sudden he has a good friend that's a mortgage broker, and the mortgage broker said, hey, look, this note's going to pay you 11% on a 50% LTV property, and his name was Leroy, and I think his comment was, well, gee, I hope they default, because he was so happy getting that loan in that place. Well, during the ensuing years, he started with that loan, and he ended up rolling several $1,000,000 through us, all buying paper. I think the best deal he did, I think a wind power company needed 900 grand. And so he made the loan to him, is paying 19%. And in that situation, he was clearly cheering him on to default, which they didn't, but all those notes worked out very well for him, and ultimately they're passive investments. And I guess my comments on notes are never anything but a first, and never for anything more than you'd be happy owning the asset for. So just keep that in mind, and lots of our clients buy paper. So this gentleman came to us, and this is another situation where they're just diversification, right? And wanted to go out and take some of his retirement account and go buy an apartment building. And the reason I put this one in here, I didn't put it in black and white, but this gentleman said, look, I need, I want to diversify in the multifamily stuff. It's going to give me some nice cash flow, which I need. Well, the only way the cash flow is going to be a benefit to him personally is by taking the cash as a distribution. So we did a checkbook IRA for him. He bought the property, and then he wanted to take distributions. I wouldn't take those distributions monthly, because it gets convoluted with respect to dealing with the operating agreement on the LLC, because each distribution, you're taking a distribution, and how does that impact the funds that are in there? The other thing, keep in mind, is that every time you've got money going in or out of a custodial account, there's costs associated with it, because that distribution, as I mentioned earlier, is not going to go straight from the IRA LLC to him personally. The distribution had to go from the LLC through the trust company to him. So instead of doing it monthly, maybe do it quarterly, semi-annually, but understand that that is happening every time there's cash coming out. It's treated as a distribution, taxable to you. And once again, you're going to pay normal income tax on those distributions. So a comment on distributions too. In-kind distributions, as I said earlier, you're with an in-kind distribution, you've got two opportunities. One, valuation, what's it worth, right? If you've got a buyer and seller agreeing to a value of a property, you've got two parties agreeing to a value. Otherwise, you're always looking at somebody's perception of a value. Is it worth the tax statement? Is it worth what the broker says? Is it worth what an appraiser says? For the brokers on this call, I'm sure you've had deals that have not been done because an appraiser comes in a value that didn't work. And so when you're looking at valuations, if you're talking about fractional distributions of an asset, typical of broker's opinion of value would take care of a valuation for trust company. If you take an entire asset out one time, they're going to want some form of an appraisal, because obviously there's some potential there for you to misstate a value on something. But one, the valuation is always going to be sort of subjective when you're taking in-kind distributions. Two, once again, if you talk about a minority interest, you can discount that valuation. But the reality is, either way, you're pulling money out. You're taking not money out, you're taking a distribution that has a monetary value. And the great thing is you've got some opportunities with the valuation discounting. The downside is you're not receiving the cash to pay the tax obligation. So you have to make sure you're ready to pay that obligation when it occurs. And a lot of times what people do is after they take the asset out, to do a cash out refi on the property to pay the tax obligation. So, once again, when it was in the account, it requires non-recourse debt. When it's part of the retirement account, when it's outside of it, just go, talk to your friendly mortgage broker and deal with that. So the cash flow out the asset is the retirement accounts. It's going to just be building the value of the retirement account, and then you're going to pay tax on those distributions as they occur. Last page. So we got through it, considering I started so late, and we got through it pretty quickly. This packet will be available to you, and at the end of it, it's got a thesaurus or a glossary that covers a variety of the different terms we've talked about. We obviously used a few industry slangs, but I think you'll find it helpful. And if you got questions, please don't hesitate to call. But this sort of wraps it all up. When you're looking at any investment, the retirement account, plan ahead takes 2 to 4 weeks to establish your self-directed IRA. I rewrote this thing last night. I need to change it. Think of probably with a checkbook IRA, it's going to take the better part of a month these days. Things just take time. It takes time to move assets from trust company to trust company, and it just be aware, even getting bank accounts set up, everything that has to happen, because really with a checkbook IRA, money's got to move from trust company A to trust company B. Trust company B makes the investment in the LLC. We've got to put the LLC together, operating agreement, EIN. You've got to go to the bank, open the, establish the account, get the account information to us, and that money takes some time to get where it needs to be. So plan ahead. You can purchase all types of property, gold, silver, platinum, anything other than collectibles, life insurance contracts, or stock with a sub S, with an IRA, SEP IRA, Roth IRA, solo 401k. Any of those things can allow you to make those investments. You can purchase with family members and friends. You cannot purchase from or for them. You cannot sell to, your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage, negotiate from the deal's inception, the IRA LLC's name. Don't overextend. Keep a nice cushion for reserves there, because once again, if you own properties, things can happen. Costs come up. Maybe I don't know, 20, 25, 30 years ago, I had properties out in the country, and had a big hailstorm that wiped out the roofs. That was an unexpected cost that came up for us. So be ready to take care of those things. Finally, real estate is real investment. This is our few of our businesses. IRA Advantage, obviously, is what I'm representing today. You can find us at iraadvantage.com or .net. Our exchange company is Equity Advantage, 1031exchange.com. And then we've got a property listing site if you are looking for something you're not finding, or if you're a broker trying to get maybe something you don't have total control of, just get it in front of people. There's a haves once section on that. But I hope you have found today's presentation helpful. If you're in Oregon and want continuing ed for this 1 hour class, please reach out to Seymour at 1031exchange.com, Seymour at 1031exchange.com. Please also, if you got questions on different things, take a look at our YouTube channel. It's very robust, got lots of information on different things. If you have a question that is not addressed, please don't hesitate to reach out. Or if you have questions on things that were not covered today, specific topics of IRA or 1031, and you'd like to see us put something out on it, please don't hesitate to reach out. We're happy to talk to you. You can reach us at 503-635-1031, 503-635-1031, or you can reach out to Celia at Seymour, CMOORE at 1031exchange.com. Thank you very much for your day. Have a great one, and look forward to talking with you soon. Thank you. Bye-bye.